I've never actually taken a substantial short position for myself or suggest for our clients of our planning group until last week. We've just seen one of the foremost experts who made an absolute killing in AI and has now actually gone short the semiconductor stocks. We're seeing a lot of layoffs increasing in the tech market, and that's all the early signs when a market has peaked. The United States, economically, socially, and politically, is in far worse shape than any time other than the major declines. I'll probably be short and short aggressively at the end of the day.
I'm very pleased to welcome back the show Peter Grandich, founder of Peter Grandich and Co. And for the first time since 2008, Peter is going to be short the S&P 500. We're going to find out why. Peter, welcome back to the show. Now, you and I have worked together for a long time. You've always been cautious on the stock market. I was telling you offline. You haven't been outright short. You've been long other areas. You've been focused on other areas. You've been long a few minors. You've been long in gold. We can talk about gold in just a minute. But and you've been bearish on certain areas within the stock market, especially the tech sector, for quite some time. But I don't remember you going short. So why now?
So there's an old saying of mine, I don't think I was the originator. It's not how much you make, it's how much you don't lose over time that separates the winners from losers. And you're absolutely correct. I have not been an equity bull, but fortunately I focused in other areas that more than compensated and actually did better along the stock market. But I've never actually taken a substantial short position for myself or suggest for our clients of our planning group until last week. And I was prepared to do it Friday, but the market got away from me. And as you and I speak here on early Monday trading, if the market does make up much of that gain that it lost on Friday, I'll probably be short and short aggressively at the end of the day. And the reason is very simple. It's going to sound too simplistic and maybe even boring to some of your viewers. But I learned a long time ago is you start to be an aggressive seller when you can't even buy it with found money. And if you gave me free money now and said, Pete, you can put it in the stock market, you can put it on the side of the stock market, or you can short the stock market. I think the market is so overvalued and overbought now that I would choose the short side.
Okay. Well, let's talk about other sectors in just a bit. Valuations, according to Goldman Sachs, are yet to rise. So, yeah, they're high compared to the long run history. The P ratio is higher now than it's been about 87% of the time over the past 40 years. So even Goldman Sachs agrees with you. However, their equity analysts say that it's still yet decline about 6% to a year-end target of 7,600 as of April 24th. And now this is largely due to what they believe is going to be continued outperformance within the tech sector. Is AI investment driving stocks higher? I'll save you the surprise. The answer is yes. So, what's your take on the notion that the AI boom isn't over? CapEx spending is going to continue driving some of these stocks higher and push up the entire sector higher, entire stock index higher.
Well, I respectively totally disagree with them, and that's what makes markets. I think we've seen the peak in that area. I think we're seeing some of these signals now. We've just seen one of the foremost experts who made an absolute killing in AI and has now actually gone short the semiconductor stocks. We're seeing a lot of layoffs increasing in the tech market, and that's all the early signs when a market has peaked. We've also seen just outright off the chart bullishness in that area. And so that is just one of the many reasons why I think the market is overvalued. But I'll tell you this, what I'm up against, if you weren't going to ask the question, I'm going to ask it for you. What could go wrong with your choice if you do that? Because I have been wrong in the past. The two things I'm betting against right now are the underpinnings to the stock market. One is the simple fact that we have an entire generation of financial advisors and investors who have profited correctly by always buying every pullback, because every pullback eventually went higher. And that's the mentality now among the vast amount of people managing money as well as their clients. And they don't believe there's any reason that this time it's going to be different. The second reason is probably even more powerful for an underpinning, and that is the versus managed money versus non just non-aggressive managed money, or what we like to call passive investments. The passive investments now make well over 50% of all the money in the stock market. This is in a sense, and I don't want to be implied it's a Ponzi, but it's a Ponzi-like scheme because money keeps flowing in and automatically has to be put to work. A manager, he or she doesn't have any discretion over it. So as long as that excess money keeps flowing in, it gives an underpinning and a look that the market is only going to continue going up. Those are the two and only two concerns I have if I end up, by the time this day is over, short. Everything else that I learned over 40 years screams to sell the stock market. But those are the two things that could, if I end up wrong, it's going to be because those two things continue and I end up losing money being short, which I'm not yet, but I'm prepared to be.
I'll give you another concern as well, Peter. President Trump has confirmed that over the course of his visit to China, he's learned that China has refrained from buying NVIDIA chips, even though the U.S. has allowed them to do so, because China wants to remain independent in that sector and they're developing their own chips. Let's suppose, for the sake of argument, that it's only a matter of time before China comes up with an NVIDIA competitor or even a competitor to TSMC. What then happens to the tech sector of the U.S.?
I think the answer to your question is it's not a question of if, but when. And I think that's another great concern and a great point. But I'll tell you this, since you touched on China. Think about our interviews from last year. And I kept saying that the fatal mistake that Trump was making, that he was going to pay for in this year, was he went in with a big stick, if you remember me saying, instead of going in with an olive branch. In fact, you remember when he absolutely came out and said, I'm going to break the kneecaps of the BRICS, which is led by China. And here he was, not a year later, basically with his hat in his hand and trying to bring over all our leaders to trying to get China to do something, because his trade actions have gone greatly against him. Not to mention, which is another factor why Friday I was even more thoughtful of going short, that we find the president of the United States has been buying hundreds of millions of dollars of stocks just this year alone on companies he's constantly speaking about and encouraging people to invest in. These are all the signals and indicators of things that happen in excess bubbles. Now, let me just say this to you. I put this report out a week ago. I viewed it as a game of craps in a casino. And I know if you don't understand what the game is about, it'll be confusing. So I'll be very short on this. The game is simple. You throw a number. If you bet on the person shooting, you got to make that number before a 7 comes out. Well, obviously, casinos have stayed in business because 7s normally come out, and they come out pretty fast. On a rare occasion, you might have been in a casino. You didn't have to play. You hear people screaming all over the crap table because the person throwing keeps making points and not a 7. When you watch the psychology of the people at that table, what they get like compared to where they were just a year ago, they believe the 7 is gone out of the dice. That's how I view where the stock market was a week ago, that people no longer believe it can go down for any real reason. And that's why I was prepared to actually get short, so seriously short, for the first time since 2008.
Before we continue with the video, let's talk about a company that's building serious gold leverage for the long term. Our sponsor today, Stellar Gold, is sitting on 3 major Canadian projects. Tower and Colomag are among the largest undeveloped gold sites in the country. The Tower project alone could be worth $2.5 billion after tax at a $3,200 gold price assumption. And if prices go higher, so does its value. Colomag spans over 1,000 square kilometers of greenstone deposits and could be Canada's next big gold camp. They also have Hollinger Tailings, a cleanup project that could deliver near-term cash flow. Across all projects, they've drilled over 16 million ounces of gold, which would cost over $2 billion to replicate today. With a seasoned team, Stellar Gold is one company to watch. Scan the QR code here on screen or visit stellargold.com/David Lin to learn more. How can you be so confident to go against the grain is my question. What are you seeing that the crowd obviously isn't, because they're long and you're not?
Well, I think it's A, because I've been a contrarian most of my career, and B, I am a riverboat gambler. And I've told you this over the years from the first time you interviewed me. Wall Street came up with the word speculation, so we don't call it what it really is, gambling. But gambling and speculating is the same thing. And I'm gambling. I'm taking a substantial risk where a good part, if not all my capital, could be lost. But I've also seen the psyches at bottoms and tops, just like it was 5 years ago when I turned to our planning group clients, who are, a lot of them are based on livelihood is on their fixed income, and tell them that bonds are absolutely going to be the worst investment for the next 5 years, and you got to sell them and own gold. I've said this publicly. Only one client, we have a four-figure number of clients, only one listened to a T. And that was impossible to believe. But the psyche then strongly suggested that type of action. And I believe the psychological level now of where we are in the market, when we look at all the other fundamental reasons that historically teach us that the stock market is overvalued, if not very overvalued, throw in that psyche, it just screams that now is an opportunity to actually short the stock market.
Are you going to be selling your gold mining companies as well then?
No, because fortunately, as you remember, late in January, I removed myself from gold. I removed myself from all the shares but one. I have gone back into 3 or 4 of them. I have not gone back into the physical metal. I do believe silver and copper have already bottomed, but gold needs to get above 4,800 for at least 2 straight days in a row before that correction is over. But no, I'm going to use cash that I have on the side that's been in T-bills and all, and take my position through that short position using some of that capital.
Can you jot our memory, Peter, and tell us what happened in 2000? Let's go back to the start of the dot-com bubble, the beginning of the end for tech stocks back in the dot-com era. So what was the trigger for the collapse? Any signs that showed that stocks were cracking, were about to crack, that people may have seen? And then, of course, as you know, the house of cards fell, seemingly overnight. Now, we don't want to wait till after that happens to be positioned accordingly. We want to see the signs when they occur. So let's go back to 2000, what happened, and let's see if anything similar is happening today.
Yeah, so there's a wonderful book. It's well known throughout Wall Street. It's been around for decades. It's called The Intelligent Investor. In fact, there's been circling around a meme now of people throw it in the garbage as if it doesn't count anymore because those factors don't apply to where the market is now. Not only is that totally wrong, more now than ever. The end result is people try to change, or in a sense, say there is no gravity. Gravity doesn't exist. And these are the reasons why. And so what happened was there were companies that not only had no sales, but people were basing their whole valuation on how many times somebody hit their website, when we all knew that fundamentally, longer term, you're going to need a lot more than that. And that's what turned in myself back then to be bearish. The problem now is this, David, and this is probably the most urgent point I can say is the United States, economically, socially, and politically, is in far worse shape than any time other than the major declines. 2000, 2008, 2000, 1987, and even 1929. And one of the biggest reasons is we can no longer be self-sufficient. We went from the world's largest creditor nation when I entered the business in the early 80s to an extremely indebted country that now depends on printing money and outside people for us to keep living the lifestyle we've grown accustomed to. And that's the biggest difference of the other previous crashes, including 2000.
I want to come back to bonds because that's an important point you just brought up, Peter. What is going to trigger this house of cards collapse right now? Is it going to be CapEx spending slowing down? Is it going to be China coming up with an announcement? Escalation of Iran, oil going higher? There could be a number of risks, but so far, nothing I've mentioned has caused the S&P to decline beyond what it's already done and recovered then some. So, what's the trigger for this bearish action here?
First will be interest rates, which the market had made a huge bet last year would be going down, especially with the new Fed chair, which now the more likelihood is that there'll be an interest rate rise, not lowered. Interest rates. And the number is very simple. 5% on the 10-year. The 10-year gets above 5%. and the market hasn't at least corrected hard, then don't ever listen to Peter Grandich again. And there may be people that are already at that point. But the bottom line is interest rates will be the first most important one. Bonds are starting to concern even some of the more bullish houses, bullish hedge fund managers, et cetera, of what's happening there. The economics. Many people believe that the economics is only held up because of this thinness of how AI and what was spent. But we're seeing things turn on AI, not only from the technology and all itself, but people in America now getting concerned about all these data centers, learning how much more the electricity is going up, how much water is being used. We're actually seeing data centers not able to open now. That is a growing issue that can impact that and all. But the third one, I think, is going to be the biggest of it all, and that's political, both geopolitical, as you talked about China and all, and politics here. Trump is, people, your comment section will be full of people, oh, he's a Trump hater. No, I voted for Trump 3 times. Now, did I buy into everything he said? No. But I can tell you Trump's turn in less than a year, where it helped the stock market a year ago, is now turning against it. And I think as we get closer to the election, especially as we get into June and July when the primaries start to hit, politics is going to play an increasing role. 2 things were said on Friday, and David, let me just be on record with this. Not only did we have a president come out and show that he's been buying all sorts of stocks that he's talking about publicly without ever disclosing he owned them, but then we had the Speaker of the House at a press conference basically say to the America, hey, listen, our Congress people aren't paid enough. They have to buy stocks in order to supplement their income. I'm going to tell you something. If I was a Democratic consultant, I'm not. Those are the 2 points that I think, and I think we will see them focus on that. And I think the political strength that Trump gave to the economy and the belief of people hoping things were going to get better, et cetera, is now been knocked out from under his feet. And that's going to be the other trigger to lead the stock market lower.
I want to address this remarkable post on Truth Social. When President Xi very elegantly referred to the United States as a perhaps declining nation, he was referring to the tremendous damage we suffered during the 4 years of sleepy Joe Biden and the Biden administration. So Xi Jinping said to his face that the United States was perhaps a declining nation. And Trump, pass the blame on to Biden, his predecessor. But anyway, is the United States a declining nation, or or is President Xi completely off base here?
No, President Xi is pretty well on target. And again, this has been my philosophy going back to 2021. I made a decision that the United States economically, military, and whatever was peaking. We were going to, the BRICS, as you know, I've discussed with you, were just going to be one of several different ways countries were going to move more away from the United States versus closer to it. And the biggest mistake he made last year was trying to knock the kneecaps of China at a time when it was evident that they were clearly a major challenge to the United States' so-called #1 superpower. And I think basically what we've learned, we're not supposed to hear bells when tops ring, but the change, and historians will look back to this trip that occurred here and all. And basically, Trump went over and came back with next to nothing. And quite honestly, and I know it's your background as well, but the people of Taiwan had a bus thrown under a bus. And that's another geopolitical concern, because here, what that's going to it plays into the philosophy that is growing around the world, that Trump / the United States can't be trusted or be counted on as a good ally. And it's just playing against him. And I just think all those things summed up, the things we just discussed, is going to put enough pressure to crack the bull market.
Yeah, I think what you're referring to, for the reader's reference, was that Trump reiterated that the U.S. doesn't support an independent Taiwan, but arms sales will continue to Taiwan for now. Now, underneath the paragraph that I just read, Trump continued by saying President Xi was not referring to the incredible rise that the United States has displayed to the world during the 16 spectacular months of the Trump administration, which includes all-time high stock markets and 401ks, military victory, and thriving relationship in Venezuela. The military decimation of Iran to be continued, and strongest military on earth by far, economic powerhouse again. Perhaps there is some silver lining and inkling of truth to what he wrote. Perhaps the stock market is a reflection of a return to greatness of the United States. I'm just saying perhaps. What do you think?
Let me go through those three quickly for you because I know time is limited. First of all, on the stock market, the upper echelon, perhaps only the 1%, but maybe up to 10%, have benefited from how the stock market has done. No question about that. But by and large, the vast amount of Americans are not, we just see statistic after statistic how harder it is for them. That's why consumer sentiment is hitting record lows, because the vast majority of people are not greatly benefiting from that. A military victory over Venezuela, I don't know if that's something I would brag about. I don't think, I certainly would say that what we were told going into the Iran situation and how in a matter of days it was going to be over, I wouldn't toss that up yet as put that in the victory column. So I think, again, a man who is narrowly focused, and now I think more and more people are going to question, was he narrowly focused because he had personal gains and families and friends from it? There's a much bigger picture that has fallen apart. That people, for instance, let's give another example. One of the biggest things that helped Trump win his last election was how the farmers and the farming areas in America voted heavily for him. And one of the biggest disappointment now on them is they've not gotten what they were promised, more buying from China, better funding for them and all. But on top of that, a war that they feel that they didn't want to be in to begin with caused one of the most important things that they need, fertilizer, to be risen so much that a third or a half can't even afford to pay for it. So these are all the things that I just think are adding up, David, and why I think we get into a crest where, at least for me and how I look at it, it's time to maybe short the U.S. stock market. And we'll know that in the next day or two if I do or not.
One more. So you haven't made up your mind yet?
Well, like I told you, if the market got away from me on Friday, I felt that if we rally back and we go back to another new high this week, I'll probably use that as the opportunity to get short.
Okay, let me ask you another question. Suppose something happens in the next couple of days such that you would change your mind and no longer short the stock market anymore. What would that thing or things be?
I'm going to sound sarcastic, but I've always been 100% honest with you since our first interview. The coming of Christ occurred. Outside of God coming back, I think America is past the point of, no, I'm being serious now. I believe it's past the point of no return. It is turned to the other side of the hill. And so there's nothing that I think short of something like that, other than if suddenly the market lost 30 or 35%, and maybe things even lost more, 50%, that then look worthy to buy again. But I think I'm more in the Warren Buffett camp, who is continuously moving away from the market and thinks that things can be purchased at a much lower level. I would say that I'd be happy to be in the Warren Buffett camp right now.
President Xi opened the summit last week by asking rhetorically the question, can the US and China avoid the Thucydides trap? Now, what that means is, throughout history, rising powers have usually challenged an existing superpower in the form of direct kinetic war. So he's basically asking, can the Chinese and the Americans coexist peacefully without going into conflict with each other directly? I'm not talking about proxy wars in Iran or Ukraine. I'm talking about directly fighting each other, which history has shown they most likely will do. What is your take? And then we'll move back into bonds.
What I think he was saying was, this is what you're going to get if it continues going down this road. Be prepared for China at some time to actually take that position. But keep this in mind for all the people. China does not want to see the United States destroyed. It's too big of a consumer-driven market where products and things that they hope to continue to sell in the world to be. They don't want to wipe us off the face of the earth. Now, there's another group of people that do want to wipe us off the face of the earth, but it's not China. But I do believe his message was simply saying, we're at that point now. Keep that in mind. If you don't want that to happen, these are the things we're going to expect you to do in order that that doesn't take place. There was a meme that went around, and it showed Trump saying, "I hold all the cards," and Xi simply says back, "Cards made in China." And the argument that is the United States is far more dependent on China than China is dependent on the United States.
Well, one of the key takeaways of the summit in China was that both sides agreed the Strait of Hormuz needs to be reopened. Now, the exact details of how they're going to go about facilitating that transition back to normal, that's not revealed. But would you take that sign as at least they're on the same page as to what needs to happen with the Iran war? And perhaps that's bullish for equities, stock markets, and bearish for oil. Would you read that this way?
Well, first of all, I think he has to say that politically, because if he came out and said, well, we want it closed, all the countries would say that you're not helping us. He's taken the role of what the United States would have said 20 or 30 years ago. So it was very smart for him. Plus, apparently, and there's so many conflicting reports, so you don't know exactly what to believe. But apparently, Chinese vessels have been allowed to be sailed and are coming with oil and all. But understand the damage that's done already. You can't unwind that certain products and services that people needed did not get to where they had to get. So we're not going to have certain crops grown. We're not going to have a certain abilities to be flushed with oil again. So even if tomorrow, just opened and everybody can sail, it's going to take many months to work back to a better level. And there's been such damage for here in the United States. We've drawn, here's a president that was killing Biden when he let go the strategic reserve. We've let far more out of the strategic reserve now because of this situation that occurred than anything that Biden did. So I don't think there's a cure-all that suddenly the strait is open and everything goes back to hunky-dory. I think what the Middle East conflict caused, it caused people to look under the carpet, and now they're seeing things that, wow, I didn't realize it was really this bad. And I think that's more and more what people are going to be looking at.
Okay, on to bonds. You are bearish on bonds. Are you expecting the Federal Reserve to raise rates this year?
I believe there's a more likely chance of a raise rate than a decline. Now, they may just continue to take the middle road in that, but go back to what we've heard since 2023 and 2024 from Wall Street. Next year, 5 cuts, 7 cuts. We're going down, interest rates are going to go lower. It's going to help the real estate market. People are going to be buying homes and all. It just keeps going the opposite way. And the key reason to that is, and people that have heard this for years, especially gold people, they don't even want to hear it. Oh, there's a debt crisis. There is, because it's gotten to the point where it's no longer 20 years down the road. It's no longer 10. Think about just in my career. It took us 26 years to go from 1 trillion in national debt to 10. Then it took only half of that. It only took 12 years to go from 10 trillion to 20 trillion. Now it's taken only 6 years to go from 20 trillion to 40 trillion. This debt, which again, people are moving away from the United States. Net sales of treasury bonds continue negative from foreign investors, putting more of the emphasis on our back. So interest rates, to me, can only work higher over time. They're not going back to 1%, 2%, or 3%. And that comes at a time when we're not even talking about states and locals, with half of all states in the United States right now can't balance their budget. Remember, governments can only do 2 things, whether it's Canada or you can raise taxes and cut services. And that's what we're going to see more and more of here in the United States.
If you're bearish on bonds or you're also bearish on gold, here's a gold chart. I'm going to overlay this with the U.S. 10-year yield, and you'll see that gold has lost a lot of steam ever since the beginning of March. It had a tremendous start to the year in January and February, but it's lost some steam. And you can see here by overlaying gold to the U.S. 10-year Treasury yield, there's an inverse relationship, and the yield's been rising while gold's been falling. That may be one explanation, but what is your explanation as to why gold's been underperforming lately?
Well, first of all, let's understand that as a buyer, when it was as cheap as 12 and 1300, And by this January, when this parabolic rise became so insane, told everybody sell all you. It can't sustain itself at this level, and look for a pullback at least to 4,000, which we came like this close to. So I wasn't a bull through all of this decline that supposedly has occurred here. But to be fair to that, you need to also recognize that interest rates went from 1% to 5% in the last 5 years, and gold went from 1,300 to 5,400 before going to
Yes, good point.
4,000. So you can't argue that interesting. It might fit at the moment, but longer term, that isn't the factor. Listen, here's the bottom line, just to an old whiz kid, former whiz kid, whatever they want to call me these days. Gold had a tremendous rally the last 5 years, especially last year, triple digit. You can't expect triple digit each and every year, because if it does, everything else isn't going to matter. Because if gold is 10 or 15,000 1 year or 2 years from now, basically life as we know it has got even 10 times worse. The bottom is it went parabolic. It brought in a group of momentum people that couldn't care less about fundamentals and all. They just saw something going up, and they, just like it is now with the semiconductors and all. And it needed to correct. Silver has finished its correction, in my opinion. If you remember, I always told you my favorite metal was copper, and I never moved away from copper because I said it was the turtle in the race, and the turtle always beats the rabbit. Its fundamentals have never gotten better than it is now, and even silver's fundamentals. And you know, my old line, I always treated silver as a second-class citizen to gold until last year when it broke under 30, and I was awakened to how the fundamentals have changed positively. It's already made its low. The only thing left now to do, in my opinion, is gold needs to close above 4,800 at least 2 times in a row or on a weekly close. That'll flip the charts. That'll get the people who are selling it now technically, and also who are selling it because they need to raise money somewhere and they want to hold on to their stock investment. So, hey, let's bang this gold down. Looks like it can go lower. When that flips, then that corrective phase is over and we'll be in the next up leg in the precious metals market.
Okay. Now, why wouldn't you go into gold? Forget cash for a minute. You're probably going to be short on stocks. You're moving away from bonds. Don't you need a bond replacement as the counter equities asset?
So for our clients, yes. For me, no. I'm a riverboat gambler. I'm always tossing the dice. That's just the risk. And so my view here is this. While I believe gold and silver will go higher, I believe they will eventually take out the highs they made early this year. May not be to next year, but they will. The leverage now in that comes from the companies that produce it and explore for it. It's their day in the sun. And if I'm correct about the metals going up to begin with, then the leverage is going to be on the producers and the exploration side. If I'm wrong about it and gold goes down, most of them are going to, go down as well and all. But understand this, David, one of the things that separated me all the years, and one of the reasons why I wasn't the most popular guy for 25 years speaking at the gold shows, is because I've never owned gold because of fear reasons. I bought and sold it because I either thought it was going up or it was going down. For people that are concerned, and they have rights to be concerned, yes, looking at gold. But a gentleman that I had on a webinar that you've spoken to in the past, and I think is I call him the Elon Musk of metals and mining, Michael Gentile, brought up a comment this weekend, and I published it. I put it up on my X page. Why Tether may be the biggest bullish factor for gold that most people still are not focused on. Tether has actually bought more gold than even China has, or what we know at least what China has. So there's still a reason to believe that gold is a much safer and better place for me to be than even general equities or bonds. But I'm going to try to use the leverage of that to make better on capital gains through the mining shares and the juniors.
The World Gold Council, I spoke to the CEO of the World Gold Council at a crypto conference in Miami last week. I asked him my first question, what are you doing here at a crypto conference? He said the World Gold Council is trying to tokenize or work on a project to tokenize gold, putting it on the blockchain to help it gain access to a lot more investors. I wonder if this is going to have any impact on new demographics of investors for gold. What's your take? As a seasoned gold investor for many decades now, Peter, what's your opinion on gold being put on the blockchain?
So here's what I think the big giants of Wall Street have not said to their clients yet, but they say behind closed doors. Hey, listen, crypto's been great. We made some serious money, but the big money's still not coming. Central banks are still focused on gold, blah, blah, blah. Hey, this tokenism can really be the best of both worlds. And that's what I think they concluded on. And that's why the talks of JP Morgan and all them doing it. And, again, Gentili opened my eyes, and I spent them yesterday and into this morning reading more and trying to understand Tether and where it was going. And I'm saying, you know what? That absolutely does make sense. That would give the both of both worlds. And that would open the door, I think, to the central banks who didn't like, for instance, Bitcoin, but could see crypto and blockchain separate from that with gold as a way of maybe working towards a solution to the world fiat currency crisis, which clearly the United States is going to have because it's the world reserve currency.
Peter, I'm going to end on this note. What keeps a man or woman rich or wealthy?
So if you're asking Peter Grandich for his view, I believe if you don't have a sense of faith, how you get to it, that's your choice. But if you believe that this is just it, and after your time here on earth, it's over, I don't think you can ever gather enough possessors and things to ever be totally satisfied. For me, I would answer simply a spiritual undertone or supporting to your life in general, I think makes it easier than what life would be not having that. Now, that's because my whole life, especially the last half of my career, I've worn my Catholic Christian faith on my sleeve and in business. But if you wanted Peter Grandich to answer that correctly, I believe you need to have a spiritual underpinning to your life in order to have that and reach the answer to what you just said.
Okay, fair enough. What about those other people in your planning group that are very wealthy? You've worked with a lot of wealthy people in your life, including athletes, by the way, who you used to work with. What have they done right throughout their lives? The common denominator amongst the wealthy people that you've encountered, what have they done properly?
So this is how people come to money. First, they inherit it. Certain part, they weren't the ones that originally made the large sum, but family and all passed it on. The other ways that you find that people became to wealth is through small to mid-sized business owners. Third, for a long time, although there's an asterisk now in it because that industry is changing, was commercial real estate. The only two times that I've seen with all the people, and we know we have almost $2 billion, so we have, I don't know, a couple thousand clients. So we've seen, and about a third of our clients are business owners. And you're right, I used to deal with some of the more wealthier professional athletes. The other thing that you see is when the stock market came involved, there was only two ways. They either worked in financial service industries and made a lot of money as an advisor, or they worked for public companies where they were granted a lot of stock options over time, usually at a great discount, and came wealthy. David, in all the years and all the people I met, you very rarely hear this story. Hey, mom and dad put a few thousand away into the market every year, and they made $3 or $4 million. Being more in charge of your potential versus depending on complete strangers out there who may not have the same incentive. And answer truthfully, David, 100%, it is so much tougher now to be in the stock market than it was for somebody back in the early 1980s. We answered before about how over half the money is passive. That remaining half, 2/3 of it's computer trading, algorithms. The president says something an hour before stock futures open. Those computers kick in, buy stocks, cause the market to go up. Everybody goes, well, look, the market's going up. We got to get in on it. That didn't exist 40 years ago. So one of the rules I tell the people with no hair and gray hair like me, David, you can't trade the stock market now like you used to back in the 70s, 80s. It's a totally different species right now.
Well, you know what? I'm going to end on one final question because this is so important. I've been thinking about this question a lot myself. As somebody who's in my mid 30s, planning for retirement myself, one day I'm also going to take a break from work. So the question that I've been asked by my peers is, what are you going to do with your money and how are you going to invest it? And I figure, look, I talked to hundreds of people at this point probably thousands, I've come to the conclusion that everybody's smarter than me. There is no way that I'm going to beat the market. I don't have time to stock pick. My job is to interview people. I'm not a fund manager. I'm not an advisor. I don't have any insight on individual stocks that will give me an edge. And so my conclusion is, and feel free to talk me out of this if you don't think that I'm right. I'm going to do exactly what you just said, which is to put a couple thousand or a couple tens of thousands of dollars into the S&P 500 every single year and just leave it. And in 40 years, my kids will have some inheritance money from the market that hopefully will have gained a lot over the course of the next 40 years. And my couple $1,000s every year reinvested will have multiplied exponentially. Is that going to be, will that work for the next 40 years?
Well, those of us that first of all, I'm glad to hear that you'll be married. I'm finally glad to hear that you're getting married because you're going to be
one day.
kids.
Who knows?
Okay. The second thing is those of us who look into a crystal ball, the only thing we become experts on is how to eat broken glass. No one knows the future. I can never tell you you have 40 years. What I can tell you is what I said before. Most people that I met up through now that had any real wealth didn't make it by sitting home and buying and selling stocks.
Yeah.
They did it through business ownership, inherited it, commercial real estate, or they were in the financial service business, came experts, and people paid them a lot of money hoping to do the near impossible you spoke about. Remember this. Nobel laureate studies have shown that 80% of all fund managers underperform an index fund. So if you want a reason to keep doing what you were going to do versus trying to find the smart guy that may keep beating the market, 8 out of 10 financial advisors underperform an index fund. And so therefore, I don't know if people would go to a doctor or a lawyer if they kept finding out that 8 out of 10 of them underperform what they need done. So
I just think, look, if 8 out of 10 professionals underperform, and I've seen that stat myself, what chance do I have? And I don't want to go off and tell my followers who are also probably in a similar position as me to just put your money in the S&P, because what point is that? Then don't even bother even listen to my show, because just let the market do my thing. So many people think they have an edge, and I just think I don't, is my conclusion. So I'll leave it on that thought. Yeah.
Let me just commend you for being a host for somebody that is hoping people are coming to in English. They're hoping you have somebody that's going to tell them a great thing and they can buy stock.
Sure.
Being candid with yourself and dealing with what you've learned and all, you've already are 2/3 of the way there versus, well, I can't say that because if I say this, then people are never going to tune into my show again, and I'm never going to make enough money to do and put them in the end. Being truthful with yourself and living with your decision making that you've concluded and all, you're 2/3 of the way there. I'm not saying it's right, but people never have a real plan. Do you know that 2/3 of Americans that earn over $250,000 a year don't have a true financial plan? And the ones that have a plan, they have what's called needs-based planning. Right now, they may be focused because they got young kids, so they're focused about the kids' education. And then suddenly they realize we forgot about retirement. So that you've already, at your age, have recognized this, you're well on the way to being successful.
Well, I hope so. We learned a lot talking from you. We're talking to you and listening to you speak. So where can we go to tune into more of your work, Peter?
Well, I don't know I don't think a lot of people, I don't think everybody's going to be happy with what we discussed, but most of my work now is on my X page. There is petergrandich.com. And I just want to commend you and be on record, and hopefully you don't cut this out. For you to conclude that in just the amount of time since you first interviewed me in that little apartment in Montreal, you've come a long way, David, and I'm happy for you.
Well, thank you very much. I've learned a lot from talking to you, and we all have. So thank you for coming back on the show. We're going to put Peter Grandich's link for X down below. So please do follow him on X and his website. I'll put that down there as well. I know he does. You do a weekly audio cast now. Is it a webcast? Peter?
I do some video, but mostly posting on my X page.
Awesome. Okay. Well, follow Peter there. Thank you again, Peter. We'll see you next time.
All the best. God bless you, my friend.
Thank you for watching. Don't forget to like, subscribe.